Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking all about the bond market. The bond market is a sector of the overall markets that is huge, it's vast, it's massive, and I think it's often misunderstood by many. So I wanted to spend today's episode discussing the status of the bond market. What is the yield curve doing? What does that mean for us as savers and investors? What is the U.S. T-bill rate doing? What about mortgage rates? What about the Federal Reserve? How do all these things fit together? What do they mean for the economy, and what do they mean for us? So today I go through all these items in a fair amount of detail. I happen to find the bond market super interesting. Some people find it very boring. I am not one of those people. I get fired up by this kind of thing. So I want to share my perspectives on the status of the bond market, what's going on, what I'm paying attention to, and what that means for us as investors. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. All righty. There we go. We're recording. This week on the show, I would like to talk about the bond market a little bit because the bond market has it's very interesting to me right now. It's gone through some interesting changes, particularly with the inflationary environment and what the Federal Reserve is doing. We have interest rates going up. We have an inverted yield curve, yet the TED spread is quite low. I'll explain what that is in a few minutes. Mortgage rates are higher than they were, but rates on deposits are a lot higher as well. There are just a lot of interesting things going on in the bond markets, and bond markets are kind of a reflection of what, well, let me rephrase that. Yields and the yield curve and what the bond markets are doing are a reflection of what the bond markets think about the economy. And historically, inverted yield curves have been a pretty good predictor of recessions. A lot of people have been very concerned that we're going to fall into a recession. Think about what the rhetoric and the headlines were about a year ago. Everybody was second guessing what the Federal Reserve was doing. They had to walk this line between raising interest rates too fast, and in their effort to stem and push down inflation, they raise interest rates too fast and crush the economy, or did they raise them too slow and allow inflation to persist over a longer period of time? And it seemed like that tightrope walk that they were walking was impossible. Nobody thought that they could both raise interest rates at a pace that pushed down inflation and avoided a recession. And I don't know that we're totally out of the woods on this yet, but look at what's happened since then. Inflation has gone down substantially every single month over the last 15. Every single month they come out with the inflation numbers, it's down every single month over the last year, almost the last year and a half, I want to say. Interest rates have gone up. The economy seems to be chugging along really, really well. Oh, and by the way, the stock market has proved very resilient after the beginning of the rate increases last year. So I don't think anybody expected this to happen. People were throwing the Fed under the bus. Nobody thought that they were doing an adequate job. Everybody thought that they could do better than the Federal Reserve. Turns out they were actually quite smart in their tactics and their communication. And this is all just very, very interesting. And what that means for us on a day-to-day basis is, well, now mortgage rates are a little bit higher. Now what you get in savings on your cash is substantially higher. At least it should be. If you have a bank account at a big bank like Chase or Wells Fargo or Bank of America, those big banks have a lot of brand power and brand equity and don't have to pay very good rates on their deposits to get customers. So you might not be getting a very good rate if you have a savings account there, in which case I would encourage you to look around, because other high yield savings accounts are paying like 4.5% or more these days. We have an option through our advisory firm that's offering 4.9% currently on bank deposits. It's a really, really different environment today than it was just 10 months ago. So let's set the framework for today. I want to go over a couple numbers, a couple things that I look at when I evaluate what's going on with the bond markets, and then just kind of explain what I see. I hope this is interesting to people. Our market-related episodes get a whole bunch of downloads, and it has implications. What the bond markets are doing has implications for your portfolio, for the stock market, for your financial planning, mortgage rates, other rates on loans. It's just a very interesting segment of the marketplace to me. So just to start, I want to talk about the yield curve. The yield curve is a chart that shows us what the rate on U.S. government debt, what the yield is on U.S. government debt is currently at varying maturities. And we care about this for a number of different reasons. So as you know, as we've talked about a lot on the show, the U.S. government has to borrow a bunch of money because we run deficits every year. We spend a lot more than we earn. So earn through tax receipts. So we have to go out there to the markets and borrow money. And sometimes the Treasury borrows in short-term, over short-term time horizons, overnight, 30 days, 90 days. Those are all short-term T-bills. The rate on those T-bills, 90 days these days, is maybe around 5.5% per year. And what that means for you as a saver is if you have cash that you know for certain you're not going to need for the next 3 months, and if you have that cash in a savings account at Bank of America where you're not earning hardly anything on it, you could take that cash and go buy a T-bill and earn 5.5% per year. 2, 3, 4 years ago, this didn't really matter because interest rates were so low that you wouldn't get a substantial improvement on whatever the bank was paying you. Bank deposit rates were low. U.S. T-bills were super low. It didn't really make a difference. Well, now interest rates are a lot higher. It makes a huge difference because a lot of these big banks haven't adjusted their rates. Because when they don't adjust their rates, they make more money. They take your cash, they go buy T-bills, they get 5.5%, and they don't pay you hardly any of it. So on the short end of this yield curve, remember the horizontal axis is maturity and the vertical axis is yield at varying maturities. So you could give the U.S. government your money over 30 days or 90 days. That's the short end of the yield curve. And you could buy a 10-year U.S. bond. The farther you go out, the longer you're locking up your cash for. You're buying a bond. Maybe you go out to 20 or 30 years. If we plotted what the going yield was, how much interest you get in exchange for each of these instruments across varying maturity dates, that's what the yield curve is. And in an ordinary environment, the yield curve kind of slopes upward because you have a lot of confidence in what the world is going to look like, 30 days, 90 days down the road. You lock up your money, the government will pay you some interest for that. But the longer that you go, the more ambiguous it is. The more uncomfortable investors tend to be locking up their money in a long-term bond over 20 or 30 years. And in an ordinary environment, when we have a steady rate of inflation and we expect reasonable future economic growth, the yield curve slopes upward. If you buy a 10-year bond instead of a 30-day T-bill, usually you'll get more interest on an annualized basis. The farther out you go, usually the more interest, the more yield that you get. Well, right now, the yield curve is inverted, meaning that the short-term yields on U.S. government debt, 30 days, 90 days, 18 months, are substantially higher than they are on 10-year bills or 20-year bills or 30-year bills. That inversion is interesting. And in the majority of cases throughout history, that tells us that, in the majority of cases throughout history, if the yield curve has been inverted, that has directly preceded a recession. And a lot of the marketplace kind of expected that maybe a year ago. A year ago, when the Fed started raising rates, the yield curve started to invert then. I think this has been the case for maybe the last 12, 15 months, something like that. The Federal Reserve met. They realized we need to get in front of this inflation thing. They decided to raise short-term interest rates. The Federal Reserve has regional banks around the country. There are 14 members of the Open Markets Committee that are executives from those regional banks. They meet and then they vote over interest rate trajectory, right? And so they increase the federal funds rate, which is the shortest end of that yield curve, because they have the market power to do that. They don't set what the yield is on the 10-year U.S. bill. They don't set what mortgage rates are. They don't set what a 30-year U.S. bond is going to yield. The markets do that. The only thing that they set directly and deliberately is the federal funds rate. And so they pushed up the federal funds rate to tamp down inflation. Higher rates of interest they tend to put the brakes on the economy. That tends to quell inflation and push it down. And at that point, the yield curve was inverted because the market didn't think, based on the 10-year yield and beyond, the market didn't think that this would be around for too long. And they also thought that it would push our economy into a recession, because historically that's been true. When the yield curve is inverted, it's preceded a recession. The bond markets are just generally pretty decent at predicting what's going to happen down the road. So now fast forward, inflation has come down by quite a bit. Economy is chugging along just great. The yield curve's still inverted, but we haven't really had any signs of a recession. And, listeners out there, a lot of people hear the word recession and it's easy to associate that with just general tough economic times. Maybe you're someone who's trying to buy or refinance a house or something like that, and you say, well, housing prices are super high, mortgage rates are super high, we must be in a recession because I can't do the stuff that I want. That only happens when we're in a recession. When I say recession, I don't mean that in general. What I mean is that we have 2 consecutive quarters of negative growth of our national gross domestic product. That's the economic definition of it. Because when our total goods and services that are changing hands, being sold around our country, are not growing, they're going down, they're receding, that lends itself to tough economic times for a lot of, not in general just something going on with housing. And that's a discussion I've had a couple times recently. So just to set the record straight, that's what I mean by recession. So the yield curve was inverted. Turns out the bond markets have been wrong so far, and it continues to be inverted. They might wind up being correct. Anytime you're looking at this stuff and charts and talking about this, you can make an argument for anything by adjusting the timeline and cherry picking the data that you're using. So sure, yeah, we might hit a recession next year. We might hit a recession 5 years from now, in which case, yeah, the yield curve would have been correct. The farther we push out the timeline, the more likely a recession is to happen at some point. But things are looking pretty good right now. Again, inflation is down substantially. I think annual rate at this point is down to closer to 3% per year, maybe 3.25%. Looking much better. Economic growth is good as well, right? So the yield curve is one thing that we want to look at. Another related aspect of this is that the yield on the 10-year T-bill is going up pretty rapidly and has been over the last couple of months. So this inversion might be starting to unwind. What the Fed is communicating now is, remember, when they meet throughout the year, they publish minutes. They publish what's called a dot plot. And for all those 14 members of the Open Markets Committee, they publish their expectations of where the federal funds rate will be over the next couple years. and they put a dot next to each timeline and each level of interest rate. So at each timeline, there are 14 dots, and they're spread out by who thinks interest rates will be where. And it's an interesting data point that we want to use to understand how much dissension there is across those 14 members who are making these decisions, and to understand where they think it's all going. So at this point, the majority, and we'll put a link in the show notes to the current dot plot, which is kind of interesting. But I think the last poll that was taken across these 14 Fed governors, 60% of them thought that we would not have another interest rate hike this year, and may even start to reduce interest rates next year. And so that forecast tells me that it may be the case that the short-term rates are at their peak and maybe headed down. The bond market is telling us, because the 10-year yield has been going up, that maybe we are on the tail end of the inflation issue. We printed a whole ton of money with COVID. It took with COVID and all the related stimulus. Now it's working its way through the economy. It has worked its way through the economy. It's pushed up financial assets. It's driven a lot of inflation, but that may have been a short-term kind of thing. And with rates looking like they're going to go down sometime soon, we may be entering a more normal environment. So that aside, right, we have the yield curve, we have the trajectory of both of these things. It seems like the inversion is starting to unwind. What that means for us as savers is that, number one, if you're not getting a good interest rate on your cash, now is the time to look around. High yield savings account, money market mutual fund might be a pretty good option. They had a good article in the Wall Street Journal recently about the rates on money market funds. What we're seeing is that high yield bank accounts are somewhere around 4.5%. Money market funds are somewhere a little bit north of 5%. The difference is that in a money market mutual fund, you do not have FDIC insurance, and you have to buy and sell shares of a mutual fund to put cash in and get cash out. When you have a bank account, you can go to the ATM and withdraw it if you want to. With a money market fund, you can't do that. You have to enter a trade order. That trade has to settle the next day. Then you get your cash out. It's an important distinction. So money market funds are still a good option if you're comfortable with that. If you have cash that you know you're not going to need for a little while, because the environment seems to be normalizing a little bit, you may think about locking that cash up into a CD over maybe the next couple years. Because right now, 2 and 3 year CDs still have very good rates. If you go all the way out to 10 years, the rate is substantially lower. So why would we want to lock it up over 3 years? Let's say you have an extra $100,000 of cash you know you're not going to need for 3 years. You're absolutely certain there's no circumstance you're going to need it. Well, if you put it in a money market fund, you get maybe a little more than 5% per year right now, which is great. But if the Fed starts cutting rates next year, the federal fund rate goes down, the rate of short-term government paper goes down, the yield you get on your money market fund is going to go down as a result, as will bank savings accounts. If you purchase a 3-year CD now, and this trajectory, this momentum continues, interest rates go down between now and the next 3 years, you will be locking in a higher interest rate than what's available in the market. And that's true of any bond, right? And so this is the market risk that comes along with bonds is, well, maybe they reduce interest rates and then all of a sudden inflation comes back and they bump interest rates back up. Well, you had duration risk in that CD. At the end of the 3 years, you will get your cash back, provided that the borrower of that CD is still in business. But most CDs are FDIC covered. The government will step in if a Silicon Valley Bank situation happens and whoever issued your CD goes out of business in the next 3 years. So that's one observation that I have right now is it seems like this trend is unwinding. The inverted yield curve is unwinding a little bit. If you have a ton of extra cash, may not be a bad idea to lock in a higher interest rate. Same goes for mortgage rates. Mortgage rates don't have the same trajectory as 10-year bills do right now. So if short interest rates are going down and longer term interest rates are starting to go up a little bit, that may mean that mortgage rates remain high for a little while. But if you're trying to make the decision of when to refinance, when to borrow a bunch of money, you could always wait and see how it plays out, because the longer term rates are more challenging to project. Again, you have a lot of uncertainty over what's going to happen over the next 30 years, but I have a lot more confidence about what's going to happen in the next 30 days from a bond market perspective, because you're only locked into a rate for the next 30 days on the short end of the curve. What's interesting is that's the exact opposite for stocks. Over the next 30 days, I have absolutely no idea what's going to happen in the stock market. But over the next 30 years, I'm really confident that our economic engine is going to produce consistent corporate profits. And over those 30 years, the good times and bad times will average out closer to the long-term trend. So mortgage rates we know less about. US T-bills, 10 years, they seem to be going up. Short US paper seems to be going down. The TED spread is relevant here too. Apologies for using jargon and such, but all this stuff is really interesting and just really has a barometer on the economy and what's going on. So the TED spread is a really popular measure of aggregate U.S. credit risk. And it's the difference between 3-month LIBOR and the rate on 3-month T-bills. LIBOR is an acronym for the London Interbank Offering Rate. It's the rate at which banks lend to each other over 3-month increments. T-bills is the rate that the U.S. government borrows at. And so if you took the difference between the two, that gives you a pretty good measure of credit risk in the U.S. because the U.S. government is the safest credit risk on the planet, still, even after being downgraded by Moody's. Check out a couple episodes ago. I think it was episode 193, perhaps, where we talked about the U.S. Debt downgrade. But the U.S. government is still the safest credit risk on earth. The chances of the U.S. government going bankrupt and not repaying principal and interest on bonds is exceptionally low. And when the U.S. government borrows over 3 months, they have to pay a rate to investors for that loan. And the rate is based on the economic environment. So a 3-month rate is like we were talking about, close to 5.5% right now. Well, the 3-month LIBOR rate, the rate at which banks lend to each other, includes all the exact same market dynamics that the U.S. government deals with, on top of the chance that the borrower of the cash goes out of business over the next 3 months. With the U.S. government, that's not the same risk, especially since we raised the debt ceiling here recently. So the difference between 3-month LIBOR and 3-month T-bill rates gives us a pretty good measure for credit risk in the economy. And when that spread is very, very wide, it tells us that there's a lot of risk in the economy. Investors are very concerned about the economy. They're very concerned about the viability of the borrower because they're demanding more interest in exchange for lending money over the next 3 months. When credit spreads are narrower, it means they're more confident about the economy. They're requiring a lower premium on top of U.S. T-bills to lend them money because they think the chances of not getting that money back from the borrower 3 months later is lower comparatively. Well, over the last 18 months, the TED spread has tightened by quite a bit, which tells us that the bond markets are more comfortable with the economic environment. They're not requiring borrowers to pay as much of a premium over U.S. Treasuries, and therefore the likelihood that borrowers are going to default becomes substantially lower. So it's interesting. We've got the yield curve is inverted. That looks to be unwinding because the Federal Reserve has communicated that short-term rates are more likely to come down over the next year or two than go up. 10-year yield is going up, has been over the last couple months, seems to be going up steadily, and the TED spread is rather tight. So that's generally a good sign for the economy. Now, what does that mean for our bond investing? For our bond investing, there are a lot of ways to attack this. I will sound like a broken record when I say just buy a diversified fund with some short bonds and some long bonds. If we think that the aggregate long-term rates of interest are going up, that means that we want to have less duration. We want to be able to reinvest cash at that new higher rate sooner and not lock it up for quite as long. Recently, the 10-year yield has gone up. The mortgage rates have gone up by a little bit. But in general, we don't want to make that forecast over what's going to happen with 10 and 20 and 30-year yields because it's just a complete crapshoot. I have a lot more confidence, again, over the next 30 days, the next 90 days, the next year or two in the bond markets than I do over the next 10, 20, 30 years. And for that reason, just buy a diversified fund. Don't take too much credit risk. Make sure that your duration is reasonable for what you're trying to accomplish. These days, coincidentally, you can get a little bit better yield by going on the short end of the curve, but we kind of want to lock that up too. So that's a consideration. And on top of that, we want to compare the cash we have as an emergency fund to the duration of our bond portfolio. And this is a slightly different angle here, but it's all relevant. Let's say that you're stepping into retirement. You've got 60% of your accounts in stocks and 40% in bonds. If you spend $100,000 a year and you have a $1 million portfolio, then hopefully you have some other sources of income coming in from Social Security, maybe a pension, so that you don't have to take 10% or $100,000 from your $1 million portfolio every single year. 10% of a withdrawal rate is probably not going to make your portfolio last very long. So let's say hypothetically you've got $600,000 or 60% of the portfolio in stocks, $400,000, the other 40% in bonds. Well, at $100,000 of withdrawal rate, that gives you 4 years of spending in bonds. And so if you have an emergency fund of maybe 6 months worth of expenses, then if the markets are bad and you don't want to take money out of your portfolio, you've got 6 months saved up in the bank that's ready to be used in case you need it. But in a bad economic time, usually stocks are not going to do very well. What we really don't want to do, and this is the main reason we have bonds in the portfolio, we don't want to sell stocks when they're down. We want to buy them and then let them grow and then sell them when they're worth a lot more. We want to let that corporate engine work to your benefit. And that's why we want to have bonds, is because bonds are what enable you to wait out the bad economic times and not sell when they're low. Wait that period out and sell after they recover. So if you have 40% of your accounts in bonds and you're spending $100,000 a year, aside from the fact that a 10% withdrawal rate is way too high, you've got 4 years of your expenses sitting in bonds ready for you to pull from if necessary. And historically, bear markets haven't lasted for longer than 3 or 4 years. The Great Depression did. That's really the only exception. Usually markets right themselves way sooner than that. So I bring all this up because of the 400,000 that are sitting in bonds, don't go buy a portfolio of only 10-year bonds. Your duration is going to be 10. And the whole purpose of having bonds on the portfolio in the first place is so you can wait out stocks. So your duration should match or at least resemble the number of years of living expenses that your bond portfolio is meant to cover. For some people, that's 40%. For some people, that's 50 or 60% of their portfolio. But based on your spending needs, this should all be incorporated. So don't have some major mismatch. If the duration of your portfolio is substantially greater than the number of years of expenses that's meant to represent, you're taking a heck of a lot of risk. Because if those long end interest rates continue to go up, that pushes the bond portfolio down, and may mean that you need to tap into it sooner than you would want to if the market crashes. It's an unnecessary risk. It's kind of like an unforced error in tennis. To use the benefits of diversification, you just simply don't need to take that risk. You can get a better result with less risk. So that's it. That's it for today. I hope this was halfway interesting to everybody. The bond market is something that's it's huge. It's vast. If you think of all the publicly traded stocks out there in the world, Google has a couple share classes that might not be a great example, but usually corporations with publicly traded shares, they have one kind of stock. You buy shares of Coke, you're getting a little bit of ownership of Coke. You can vote in the shareholder meetings and so forth. There's only one kind of Coca-Cola stock that changes hands. But Coke might want to finance its operations through the bond market. They might have a 5-year bond out. They might issue a 10-year bond. They might have one with call features. They might have one with put features. There are all sorts of different strands of bonds in the market. And corporations really like debt financing because it's less expensive for their existing equity owners. So when interest rates are low, they issue a lot of debt because it's cheap. And so when we compare the size of the bond market out there to the size of the stock market, the bond market is way, way bigger. And there are far more individual issues, even just for one company, than there are compared to the stock market. So for that's why there's no formal public exchange for bonds, because it would be way too messy. You go through a bond dealer. When you buy an individual bond, you log into your account at Schwab or Vanguard and you look at their inventory of what they have available. And you can buy stuff off their inventory. If you want something that they don't have, you call up their bond desk and ask them to go find an ask for it. If you own something that the bond desk isn't ready to buy from you, then call them up and they go bid it out to other dealers on the brokerages around the market and ask for a bid so that they don't have to take the risk buying it from you. It's an interesting thing, and it's a really helpful barometer of what the rest of the world thinks about the economy in any given country, really, and things seem to be improving steadily. So, I mentioned in passing in various episodes and from time to time on the podcast, the numbers are looking better, right? Inflation is down, economic growth looks good, bond yields are doing this or that. This is the kind of stuff I'm talking about. Yield curve, inflation numbers, GDP, that bond market stuff has just a big bearing on what stocks do over time. So I hope this was helpful, not too boring and esoteric for people, but it's just super interesting and I enjoy talking about it. So there you go. Thanks for listening, and we'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.